Hi everyone. So in this video, we'll be taking a look at move contracts, how they work, and how you can use them to profit off of price volatility on Delta. So move contracts are a new class of derivative contracts on Delta. They work in a way where the price and the value of the contract is proportional to the absolute value of movement in the price and not in the direction of the price movement. So what this means is that it's irrelevant whether the price of, for example, Bitcoin rises or falls, as long as it moves in either direction by more than the premium paid for it. So move contracts are incredibly useful during times of high market volatility and uncertainty, with large price swings in either direction. They allow you to profit off of the volatility without necessarily having to predict the direction of the price movement. So to take a relevant example, take the Fed's most recent $700 billion injection into the US stock market. There's a lot of uncertainty surrounding this event, and it was difficult to tell whether the news would be interpreted positively or negatively. In a case like this, you can use a move contract to speculate on the upcoming volatility, predicting that a price movement will take place without having to put your money on the direction of the movement. A move contract is, in essence, an option straddle or a direction-neutral option strategy. In this way, the move contract allows you to easily trade asset volatility instead of price, profiting off of large price moves in either direction. So to actually make a trade, navigate to the Delta Exchange market page and click on the Move section. Here you will see a breakdown of the available move contracts. Let's click on the daily move option in this case. And here we are. If you look above here, you will see the information that you need to make your trade. As an example, you have the 24-hour low and 24-hour high, the time to settlement, you have the strike price, you have the 24-hour volume, as well as the last traded price. The last traded price, 220.5, is what you'll see down here in the order book as well. As this is a USDT or Tether-based option contract, you will need to convert your deposited Bitcoin into Tether before you can make a trade. The first thing to do is to choose your preferred order type. In this case, we have limit, market, and stop market. Second of all, you'll need to choose whether to go long or short. When buying or going long, it's important to note that you're speculating that volatility will be high and that the price of the underlying asset, Bitcoin in this case, will increase by more than the premium paid. On the other hand, when you choose to sell or go short, you're speculating that volatility will remain low and that your premium, the one that you receive as a short seller, will be higher than the absolute price movement in the underlying asset. So let's go long in this case. To continue, make a limit order price. We'll say 242.5 in this case for the sake of demonstration, and choose the quantity based on your available balance. It's important to note here, as a long buyer, that there are no margin requirements for your position. I'll go into more detail on this in a second. When you have all this lined up, simply click Place Order to confirm all the aspects of the price, including order value, margin levels, the available balance, limit price, and the position size after execution. Once you're ready, you click Place Order to confirm. Immediately upon placing the order, your premium will be deducted from your account, and this will go towards the short seller. Now it's important to pay close attention to the strike price of the contract. The strike price, which we see here at 6,804, is basically the starting point of the contract and the point to which the premium is added. So let's say we buy the current contract at a price of $240 with a strike price of 6,800. If we're to be long this position here, so basically what we're saying is that the price of Bitcoin will move by more than the premium from the strike price. So in this case, to either 6,550 or 7,050. If this happens, then we make a profit as a long. Vice versa, if we're short, we're speculating that the price of the underlying asset will move by less than the premium from the strike price. So longing a move contract is profitable when the price rises or falls from the strike price by more than the premium you've paid. In this sense, shorting is profitable when the price rises or falls from the strike price by less than the premium you've paid. The margin requirements for traders for move contracts are fairly straightforward. For longs, losses can never exceed the option premium you've paid. So because of this, longs can never actually get liquidated, and there are no margin requirements on a move contract on Delta. This is the inverse for shorts, where losses are theoretically unlimited if the price were to either plummet or skyrocket. As a result of this, shorts are therefore required to post a 10% margin requirement to trade move contracts. So I've attached our move contracts guide in the description of this video below.